Welcome to Market Buzz. I'm Greg Schnell, the Canadian technician and host of the Market Buzz. Each show we do a deep dive into different industries using weekly charts to see what is happening on a long timeline. Please follow me on Twitter at Schnell Investor, and you can also find my blogs on gregschnell.com as well as StockCharts.com. So this week I want to talk a little bit about the bankers that seem to be enjoying the rate rise that we've got. So the market has come through most of the big tech earnings and I wouldn't say was able to pop on the news, but didn't collapse on the news. So Facebook was bad. Amazon was good after falling hard the previous day, so it just kind of got back to where it started. Google and Apple both reported good numbers. Microsoft reported good numbers. So large cap tech largely held up. I just think the bigger issue we've got going forward is just trying to get rid of the high multiple for the overall market. And so that's what we're working towards here. I want to cover off a couple of different venues today. One of them, I want to go through some of the personal indicators I've created, and then just to give you some idea, some larger picture scale stuff, and then talk a little bit about the banks. If we get time, I'll jump into some of the metals and mining because they look ready to pop again, and I've talked about it many times on the show. Gold's rolling, talked about that on the show. Oil's topping, just even if it's just in the short term, you might want to take your profits in oil and then kind of just let it drift away, and then when we get a better buy signal coming up, it might be time to add more to it. So again, this is the kind of thing we do all the time at gregschnell.com. So if you're interested, you could head over there and try the annual membership. It's only $860, which I think is pretty good value. And then what do we carry off? Well, we have award-winning technical analysis that is covered in the weekly newsletter and the weekly video. We just did our monthly recorded conference call for February. And I work with Dwight, and Dwight also posts some setups every day. So we don't bombard you with data. We give you some good trading insights, what we're looking for, how the market's moving, and then give you some timely setups. A lot of our clients have 7 digits or higher in assets, and they're looking to stay invested in the market while it's going up and then step aside when the market's going down. Last year we got about 8 buy signals. And that gave us really good times to be in the market and then just gently step aside. Each one of the market pullbacks last year offered a change in leadership, and you might remember the big February SPAC blowout. Well, then when we pulled back after that, the overall indexes didn't fall that hard, but the composition of the market changed quite meaningfully, and tech was out of favor until May. And then in May we had a pullback, and then tech came back into favor, and then energy took off in one of the next rallies. So we had this constantly changing. So even if it's not that the overall indexes are pulling back, it might be what you're in is changing, or what you need to be in is changing. And in order to follow that wave through the market, it's pretty important to make sure you're on the right side. So with that, as always, thank you for watching the show here, and hopefully you get some ideas to help put more money in your account. We're going to start with a couple of my big picture things. So this is from my newsletter, and the newsletter this week was called Spinning Our Wheels. Lots of people in snowstorms, so that was kind of the chuckle about it, was just, we didn't have any heat in the market, and we didn't have a whole bunch of heat outside either. So a little bit of a dampened environment. But the main crux I want to try to explain to people is, where are we in the larger context? And I have a group of charts that I go through. There's well over 150 charts in there, and each week I monitor those charts for trends in the overall market. And what I'm trying to find out is, does the market have enthusiasm behind it, or is it struggling? And when it's struggling, we want to get ready to buy, and when it's running up but starting to slow down, then we want to kind of look to step aside. What this picture shows us, this blue line here, is that coming into COVID, we had a good percentage of the stocks or of the indexes doing pretty well, and then literally it fell off the cliff as COVID hit and all the governments kind of locked down, and then we had the Fed throw money at at everything. We had the governments worldwide throw money at everything. Everybody got a stimulus program. Job creation, or not job creation, but job holding. You got paid to stay home. There was a whole bunch of money, just liquidity galore. And the market took off to the upside. This is roughly when the SPAC season hit. And as you can say, that the charts didn't change a whole bunch, but at that point, the ownership level changed. And what you needed to be in had gone from being high growth, high risk assets, and the whole SPAC thing was a big volume thrust that I've written about many times. But then we pulled back, and when we pulled back on that, the main difference that we saw was an attempt to kind of move out of those large growth names, and really that's when the ARK fund kind of topped out as we changed from liquidity surplus to just kind of normalizing. And then lately we've obviously seen the Fed talk about contraction, removing quantitative easing, focusing on inflation, and that's really taken the high growth bubble away, and we've moved into something more, I don't want to say akin to normal markets, because markets are never normal, but the appreciation for, as an example, the energy sector breaking out, or the banks breaking out, or metals and mining just trying to get things done. And as Jeff Curry from Goldman Sachs said, we don't have an energy crisis, we have a molecule crisis, where it doesn't matter what we're talking about: copper, gold, steel, lithium, aluminum, oil, gas, all of it. We're short of it, and we haven't reinvested enough, and we're going to hit this wall where we just don't have enough, and it's going to push prices higher in that area. So we've seen a big rotation away from, I'll call it speculative tech. Not that that's bad, speculative tech, just envisioning the future, and then moving into a lot more stable current market situation. But the big thing that we're seeing now is that the percentage of industry groups that have positive momentum. So you can have positive momentum but declining positive, so less positive but still positive. If you think about a basketball, as a basketball rises up, when you originally throw it, it's got lots of velocity, and then as it gets towards the top of the arc, it's still rising, but it's losing its speed. And then as it starts to fall over the other side, gravity pulls it down. And so what we want to focus on is when that market hits that inflection point, that can be a pretty important signal. And recently, real rough, when we get below about 75% of all of the groups on a long-term picture, getting into losing their positive momentum and actually going negative. So when 75% are still positive and 25% are going negative, now you're starting to see the market actually have trouble going higher, because there's so much pulling down as opposed to just everything kind of lifting up. So we're sitting here and we're almost down to 50-50, which is getting much more concerning. We're not at 50-50, we're still above it, but we're getting to a situation where, obviously if all of the industry groups have negative momentum, we're probably going lower. The real important thing for us to be aware of is just that backdrop. And to me, it's now getting concerning, because we're getting to the point where if all of a sudden the market wanted to fall away, it could. And I don't mean crash, I just mean work its way lower for a while. There aren't enough groups trying to hold up, they're slipping. So when we get to this next chart, and again, this is stuff that I just track through StockCharts charts, but I go and I make spreadsheets out of it and chart it. So on this next one, what I've done here is I take all of the charts in the group and I just check where they are from a full stochastics percentage or perspective. So are they up at the top of the range, middle of the range, bottom half of the range, and bottom of the range? Looking at that gives me a pretty good clue. And the point I want to make this week was that we had a real surge in the number of industry groups sitting at the bottom of the range. And as you can see, over the last 2 or 3 weeks, really since the beginning of January, this has been accelerating higher. But more importantly, the groups at the top of the range are getting almost none. Now, when you look at that August to October 2020 perspective, things were still trying to rise up. But so you can see up above here, we were still in an uptrend, yet we didn't have many making it all the way to the top or holding at the top. But when they changed to blue. So they were pulling back a little and then they took back off again. What we've got now is that there's very few up at the very top. So again, green is still bullish, blue is positive but off the highs, yellow is dropping meaningfully away from the highs, and red is multi-month lows. So we're starting to get, a good, let's say 35% are hitting multi-month lows right now, and just very few, oil and gas would obviously be one of them as an example. Banks are doing pretty good. So they're holding up at the top of the range, but these other names are all living down at the bottom. But I think what surprised me even this week, so the S&P 500 was up, but on the big picture, this market has not been able to get more groups stopping dropping. They've literally, we have had some continue lower, and then we're trying to stabilize. So it's getting weaker in a big picture to just have the market even hold up. Whereas up here, if we had a pullback, there were still so many groups that were positive, we were going to go higher. But again, each one of those pullbacks was an opportunity to change focus and try to remain in what was working. So then we go down. So let's talk about this green area here. The next chart below is just graphing that green area only, and then the second chart will be graphing this red area, and it'll just help kind of contextualize what's going on. So when we were coming out of COVID, we started to run up, and trying to get into that top group was very difficult. We had some, but again, only kind of 2/3 were getting there. And then we pulled back in October to December, and then we went on a rally. So it was still, I'll call it higher highs, and higher lows getting over to this part of the chart. Then in June, we kind of made our high here, and then we started to make lower highs and lower lows on this index all the time. So just saying we don't have the structural strength to rally anymore, and we were literally getting about halfway, and then we would roll down again. About halfway, we'd get up into that top quadrant, roll back down. And so we continue to struggle to get going. I just think it helps show that less and less groups are able to get back to their old highs, right? And that's kind of helpful to understand from the big picture. Now this red zone that was at the very bottom is the fourth chart. And what you can see is, it didn't look too bad. Even these waves in here didn't look, depressing by any stretch. They were still just barely off the lows. But now we've clearly jumped up. And this is rather significant. But I do have a note here. When this starts to drop from a high level, you want to be getting long, not getting short. And so while we may not go to COVID lows, and I think one of the things that's important to remember about COVID, it was literally everything hit at once, and for 4 weeks we kind of went straight down. That's very difficult to duplicate without the same sort of sudden impact. So we're going to find the market having weak periods, but we'll probably rotate between what is working and what is not working. And it's that kind of difference that I think is pretty important for us to be aware of. So I don't expect it to get back up to 90% of the indexes collapsing all at the same time, unless we have something more sudden. But again, if it's not a sudden thing, just kind of slowly working it out, I would expect this to kind of come up and evolve, roll down, and then we're going to start our next bullish rally. Okay, so this is just from my newsletter, and I kind of go through everything. We're not going to cover off the newsletter today, but I published that kind of overview to help people understand where we are in the process, and hopefully that helps you kind of get a better feel. So let me just jump in here, and I'm going to go over, I'm going to cover off the index just briefly. So the Nasdaq pulled down hard, made a higher low, made a higher high, made a higher low so far. And now what we want to see is obviously a higher high. Our big issue is that we're starting to get up into this zone here. Where anybody who bought stocks in here is probably in a losing position and wants to just get their money back. And even when I talk to some of my clients or other people that are, call it, active participants in the market, but not really to the level of engaging and disengaging, I think it's not very well understood where we are in the market cycle. So what we're trying to figure out here is, do we have the energy to get all of these stocks kind of thrusting back up and make new highs together? Or are we just going to have a few stocks at a time go up? And if that's the case, it's going to be very difficult to take out the highs. And you might remember from October on, we kind of didn't have a whole bunch of momentum where stocks were getting up to the top in that grouping of full stochastics. Well, when you look at this high push here, that was kind of our last gasp up, and this is actually obviously when the Nasdaq topped. Well, we're almost 3 months from when the Nasdaq topped, so time goes by pretty quick. Again, the real question is, if we can't get a whole bunch of groups going up at the same time, we're probably going to get stuck in this area here, as some people just want their money back and the other people are expecting new highs. And so we end up having a lot of buying and selling and not a lot of progress. That's kind of where I envision us getting stuck. And if you just look at the big picture here on the Nasdaq 100, we don't go below the 40-week moving average very often. We've been sitting down here for about a month. And now the real question is, can we rally back up? This was the COVID low. This was 2018, where we dropped about 20%. Well, we've just dropped 18 or 19%. So we've already had kind of the big pull down. The full stochastic now wants to try and turn and bounce higher. The PPO on the Nasdaq typically bounces from a level like this and down around the zero level, and we get a rise back up. Now, the real question is the size of the rally. So we're trying to get that bounce right now. And I think it's just important to understand the context of that bounce. What are we trying to achieve here? Well, right now we've got too many groups that have negative momentum, and we really need the whole thing to change. And if we don't see that on the horizon, we're probably going to have a more difficult environment where you really need to trade a little bit more if you're going to take home some money. And trade means in and out, not just trying to buy to get long. Okay. Second thing I just want to show, I don't usually show this, but I just think it's important to kind of set the tone. I have a Schnell Strength Index that I go through each week. And what I look for is when you're down below 25%, you want to be a buyer. And we had a sudden dip down in December and then a rally back up almost immediately. But when we're coming out of this bottom 25%, this is a nice time to get long. And we just had this on the Monday. And part of it is we're losing old data and gaining new data. And so the old data, as it falls off, the new perspective looks a lot better. So we're starting to run up. And I still think it's an opportunity for us to take positions and try and get long as the market tries to rally out of the hole. If it can't get out of the hole, then we're going to start to kind of fail around this 50% level, and that would be more of a problem. So it's the S&P 500 up here in black and the Nasdaq 100 up here in brown. Looking at the prior September high, you can see the S&P 500 has been able to get back to it. The Nasdaq has not been able to kind of reach that level. So if we just said this is the prior high, we've kind of got a gap here where the Nasdaq hasn't been able to get there. And again, probably everybody on Twitter this weekend was drawing the head and shoulders arch for the right shoulder, and we're ready to crash lower. I'm not really on that camp because my data says we're about to improve and go on a run. Now, the real question is how long that run lasts. But for now, big picture says things are pretty good, are trying to improve. Okay, so let's get into the banks. This is just sorted based on 1 week, and you can see lots of the banks are up 4, 5, 6%, which is kind of a lot for the banking sector to move that much in a week. Obviously, yields moved significantly. What we want to do here is we just want to take the numbers off the list and just sort it by anything we want. So I'm going to scroll down to the bottom here. I'm going to select all, and then I'm going to say remove the numbers from the whole group. and that's just going to cut the numbers off the front. And then I'm going to go back into summary mode. And then in summary mode, let's say I want to sort it by intraday or at 1 week or even 1 month. Let's just see where things are moving, and we'll put the strongest banks first. So in this case, I picked 1 month. Normally, I'd probably pick a week, but it's just to kind of give you some perspective on what's going on. Now we scroll down to the bottom again. We hit number in sorted order. And by doing that, it's now going to put the numbers on here. So if we click on this, it'll rank them in order. So the strongest banks first. And if we go and we can add a scooter ranking column on here. So this is another way we could have sorted. We could have just said, let's sort on the scooter ranking, and it's going to show us the strongest price first. But look at how many banks have a scooter ranking up in the above 75%. This is pretty strong as a group broadly. They're doing pretty well. Okay, just to click in here, let's go look at view all and just scroll through some of the top banks. So what we're starting to see is this scooter ranking getting up to a higher level than it's been at in multiple years. And I know the yield is also doing that. But the point is, as this tries to take off here, some of these banks could really start to lift off. Here's HSBC. This broke out above $31 at the beginning of the year. It's now call it $32, now $37. That's looking pretty nice. Look at that bounce. PPO moving up, coming down, touching zero, and then working higher. That's a really nice sign. So what I like to watch for on the PPO, see how all of these times it's making PPO turns up above zero. So you're in positive momentum, you had declining, and now you go to advancing momentum and you're above zero. So that's a very important place for the market to be. Then in this case, you can see that the chart stays below zero for years. We've now rallied above, pull back, and we bounce at zero and start to take off. And I just mentioned that about the Nasdaq earlier. That's the kind of price performance we want to see out of the Nasdaq, is that bounce back at zero again. So here's Intesa Sanpaolo. This one's breaking out above $17. It's up to 19. It's only 10% up, but it's doing the same sort of characteristic. And we see this largely across the whole banking group. Now, a lot of the leading banks are obviously foreign banks, but they're starting to get going nicely. We didn't sort on scooter ranking. We sorted on the biggest moves over the last month. So this Banco Santander out of Brazil is pushing up higher, and you can see it's still trapped under its 40-week moving average, but we do want to see this get back into positive territory. That's when it's really going to make a move. Mitsubishi Financial's breaking out this week, bouncing off zero. That looks very bullish. Banco Santander. Here's the UBS. This chart's been grinding higher for the whole year. It was $15. It's now 20. 30% gain on a bank over the year, plus you're getting a dividend. That's pretty nice. And then when we look at Mizuho Financial, this one's just starting to get above its 40-week. So again, depending on what sort order you want to look at them, you're going to see different things start to show up. And my appreciation for the banks here is that we're getting these PPOs bouncing above zero, and that's a pretty important place to get on board. They could make nice runs when you get the turn above zero. So that's one of the things I'm watching for. And if they started to turn back down again, obviously we'd have to recalculate. But here's Wells-Fargo. It broke out beginning of the year to 52.50. It's now pushing 57, 58. So it looks really strong. CME Group, this one's just breaking out above prior highs, so that's a pretty nice move. And Toronto Dominion, this is TD Bank, big one in Canada. It's also big in New York State. Pushing up nicely here from 75 to 85. Looks like it wants to grind higher. Sumitomo, same thing, starting to break out to new 6-month highs. Bank of Bilbao, starting to push up here again. You're seeing all of these start to bounce with the PPO right at zero. That's a very bullish perspective for me. Société Générale out of France, this bank starting to click on to higher highs, was 7, now 8. Canadian Imperial Bank of Commerce, or CIBC, you might see the brand, $1.30, 130. BMO, another Canadian bank, breaking out to the upside, 120. Raymond James Financial, these are all pushing higher. So just to give you a perspective, we're seeing all of the traits we want to see with the PPO turning up above zero, relative strength starting to outperform This is exactly how bull markets look when all of a sudden you're starting to see the best relative strength in these banks. These could really make a meaningful run. Okay, I didn't get a chance to cover off the metals and mining, but go in and look at some of those stocks, Rio and BHP, that kind of thing, tech resources, they're all starting to move, so have a look in there as well. Thanks for taking the time to join me on Market Buzz. Market Buzz airs Wednesday at 10:30 a.m. Eastern. You can also see the recordings on StockCharts TV YouTube page. If you're interested, head over to Greg Schnell. There's a couple of different ways you could try our services there, and if you see something you'd like, feel free to sign up. Thanks, everybody. Bye-bye.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.